Hello, and thank you for joining this week's episode 3 of What the Insurance. In the previous episode, I introduced some very important terms. However, in the interest of time, I wasn't able to share how to apply that information to a real life example. So I wanted to take the time in this episode to show you all how to do just that. I felt a PowerPoint would be the best way to display this example, so I'm not live today. Please note the information presented here is only intended to be an example. These are arbitrary numbers and dollar amounts that I've chosen to illustrate this example. So let's get started. Your employer offers two plans, an HMO and a PPO. You choose the PPO plan. The total premium that the insurance company charges your employer for that plan is $400 a month. Your employer chooses to pay 50% of that, which is $200 a month, which means your monthly employee contribution is now $200 a month. Okay, the PPO plan that you chose has a $25 office visit copay, a 20% coinsurance, a $500 in-network deductible, and a $1,000 out-of-pocket maximum. In real life, your plan may have different costs, but these are just arbitrary numbers to illustrate the example. Okay, so now let's apply this to a real life situation. Let's say you go to the doctor's office visit and you pay a $25 copay. And while you're there, your doctor says, we need to admit you to the hospital. Uh-oh. You go to the hospital, you're admitted, you finish your stay, and afterwards, your hospital then bills your insurance company $1,000 for your entire stay. Your insurance company then applies their discount and determines that the allowed amount is $800. Then your insurance company applies your deductible, which is $500. After that, the coinsurance kicks in. This means that in addition to your $500 deductible, you would then pay 20% of the remaining balance, which is $300. 20% of $300 is $60. The plan would pay the balance. At that point, you would then receive an explanation of benefits from your insurance company, which states you are to pay $560. In an ideal world, your hospital would then send you a bill for $560 and you would pay that. After that, you will have then met your deductible for the remainder of the policy year, and that means that everything else will be applying towards your out-of-pocket maximum. In some cases, however, you may receive a bill that does not match your explanation of benefits. What do you do then? Well, that's a great question. I will explain comparing your bills to your explanation of benefits in a later episode, because that's also a very important subject. Okay, you've now paid $25 for your office visit copay, plus $500 for your deductible, plus $60 in coinsurance, which equals $585 paid towards your out-of-pocket maximum. Then you take your original $1,000 out-of-pocket maximum balance, you subtract what you've already paid, which is the $585 towards your out-of-pocket maximum, and that leaves a balance of $415 for your new out-of-pocket maximum balance. That $415 can be applied towards more office visit copays, testing, maybe another hospital stay, or even prescription drug copays. Once that total out-of-pocket maximum balance has been met within a policy period or plan year, the insurance will then pay the rest of all of your services, 100% for everything else, for the remainder of that policy period or plan year. And once that policy period or plan year ends, then this entire cycle will start over for the next policy period or plan year. Well, that concludes our real life example, and I hope that this has been helpful for you guys. Please remember, all archive videos will be posted to my YouTube page. The link is in the description below. Please like and subscribe to my YouTube page. I look forward to having more subscribers. Next week, we will move into our discussion on the next major medical plan, which is the high deductible health plan option, or HDHP for short. Thank you guys for joining again, and have a great rest of your week.